Welcome. If you're involved in trading, you already know it's way more than looking at charts, right? It's this constant mental battle. There's just so much information flying around, and you're always hunting for that elusive edge. Maybe you've tried countless strategies, felt that sting when a perfect setup somehow turns into a loss, and you're left thinking, what actually works? How do you possibly cut through all that noise?
It's a really common feeling. Information overload is a huge problem.
Exactly. So today, that's what we're diving into. Our mission here is to explore what really makes a trading edge. And we're going to shift the focus a bit, away from just the technical stuff towards the psychology, which honestly often gets overlooked but is so critical.
Absolutely crucial.
We're drawing on insights from experienced traders, people like Adam Grimes and Adam Koo, and combining that with analysis of the core skills you genuinely need. Our goal is simple, to give you a clearer, more useful understanding of how to build a sustainable trading edge. We'll be focusing heavily on that mental game, the discipline, the behavior that really supports long-term success.
Think of it as a roadmap through a pretty complex landscape.
Right, a shortcut to clarity.
Mhm.
So let's jump in. Okay, this term, having an edge, we hear it all the time in trading. But what does it actually, mean? Is it some kind of secret? Or some people just naturally luckier?
Well, it can definitely feel like luck, especially at the start, but professionals know it's not just random.
So what are they talking about then when they say edge?
Fundamentally, an edge is just something that isn't, well, random. It's a deviation from pure chance. Think about flipping a perfectly fair coin that's 50-50, pure randomness.
Okay.
Now, think about a casino's roulette wheel. A lot of people think red or black is 50-50, but it's not, is it? Because of the green zero or double zero in American roulette.
Right, those green slots.
Exactly. They give the house a small statistical advantage, maybe around, 5.4% on American wheels? That tiny skew, that's their edge. They don't win every single spin,
No, of course not.
but over thousands and thousands of spins, that small percentage guarantees they make money. That's the core idea of an edge.
And Adam Grimes, he points out something quite sobering about this. He says a real edge in the market is often paper thin, tiny.
Yeah.
Which sounds almost discouraging. Like, how do you even find something that small, let alone rely on it?
It is subtle, and that's definitely a challenge. But here's the thing. Even though it's thin, if you apply it consistently with discipline, with solid money management, that's what makes the difference between long-term success and just, random outcomes.
Like the casino again?
Exactly like the casino. They don't need a massive edge on every bet. They just need that small, consistent statistical lean executed over and over. It's about methodical application, not huge wins every time.
Okay, that consistency piece seems key.
Yeah.
And it leads us straight into the journey, doesn't it? Because becoming that consistent trader, well, it's definitely not quick. Adam Grimes' story is fascinating here. He had zero finance background.
None at all. Classical music composer.
Right, comes out of college, sees a get-rich-quick ad for trading, and just jumps in. Not your typical path.
And his early days were, well, pretty rough. Very relatable for a lot of people starting out. He lost money consistently. He was undercapitalized.
Didn't have enough funds to trade properly.
Exactly. And he wasted a lot of time on complex methods, things like Gann analysis, Elliott wave, stuff he later admitted just didn't work for him. The big light bulb moment for him was realizing his own brain was essentially tricking him. It was seeing patterns in what was actually just random market noise.
For brains love pattern.
And they really do. We're wired for it. So he realized, okay, I can't just trust what looks like a pattern. I need hard statistical proof. I need tools to actually validate if there's a real edge there or not.
Which really highlights his point about becoming a trader, not just learning to trade. It sounds less like learning a subject and more like personal transformation.
It absolutely is. And he puts a number on it, a realistic one.
Yeah.
He suggests for most people it takes a 3 to 5 year period of really focused, continuous effort.
3 to 5 years.
Yeah. It's not a weekend seminar thing, which, brings up a really important question for anyone starting out. What does success even look like during that long journey? Because it's probably not what they imagine.
And Grimes has this great framework for that, doesn't he? His degrees of success, it helps manage expectations, especially early on.
Yes, it's brilliant. He breaks it down. Stage 1, the first degree of success, and this alone can take years, is simply when you stop losing money on your actual trades. You're basically breaking even transactionally.
But you're still paying costs.
Right. You're still paying for your data, your commissions, software, whatever. So stage 2, which he calls reaching an ultra-elite level, is when your trading starts consistently covering all those costs. Your account balance is stable month after month. You're not having to add more money just to stay afloat.
Okay, so ultra elite is basically breaking even overall.
Pretty much self-sufficiency. And only then, only from that stable base, can you realistically start thinking about increasing your position size and actually generating significant income.
Wow. So hearing years and ultra elite just to break even, yeah, that probably sounds like a really long road to a lot of listeners.
And if it does, you're not alone. That's exactly Groms's point. So many people come into trading with completely unrealistic expectations, thinking they'll be rich in 6 months.
The get-rich-quick dream again.
Precisely. And that mismatch in expectations is one of the biggest reasons traders fail. They don't understand the real milestones, the time involved, the sheer grit required. They expect a sprint, but it's a marathon, and they quit after the first mile because they're exhausted and haven't won yet.
Okay, this is crucial. It's not just about finding that tiny edge. It's about developing yourself into someone who can execute that edge consistently, day in, day out.
Exactly.
And that transformation that really brings us to these 4 pillars of a trading edge.
Yeah.
This is where you get into the practical skills, right? The foundation.
Absolutely. Pillar number 1 is pattern recognition. This is the technical foundation. Recognizing common price action patterns, understanding market cycles, reading candlestick charts. It's learning the visual language of the market.
But hang on, didn't Adam Grimes warn about seeing patterns in randomness? It sounds like where it gets really tricky.
Oh.
How do you know if a pattern is real or just noise? Especially when markets are always changing.
That's the million-dollar question, isn't it? And it highlights the danger of relying only on pattern recognition. Seeing, say, a classic head and shoulders pattern is just the first step.
Okay.
The skill is in validating it. Does it align with the overall market context? Is there unusual volume confirming the move? Does it line up with other indicators? Without that validation, that context, yeah, it could easily just be noise your brain wants to see. You need more than just the visual cue.
That leads nicely into the second pillar. Mathematical probabilities. This is about getting under the hood of your strategy. Understanding your win rate, yes, but also your average risk to reward ratio. And most importantly, calculating your system's positive expectancy. Expectancy meaning whether it's profitable over the long run.
Exactly. Does it make money on average over many, many trades? This pillar forces you to think statistically long-term, not just about the next trade.
Right, and Adam Koo has a great warning here, doesn't he, about getting fixated only on the win rate. You can win most of your trades and still lose money.
Oh, absolutely. It's a classic trap. It's the combination of win rate and risk reward that matters. You need positive expectancy. Let's say you win 70% of your trades. Sounds great, right?
Yeah, sounds amazing.
But if your average loss is, say, 5 times bigger than your average win, you're still bleeding money despite winning most of the time. Your winners have to be big enough, on average, to outweigh your losers.
Okay, that makes sense. Risk management is key.
Which brings us perfectly to pillar number 3, human behavioral tendencies. Now we're really getting into the psychology. This is all about being acutely aware of your own biases and those of the crowd. Fear, greed, overconfidence, impatience. They're everywhere in trading. Understanding these doesn't just help you avoid making biased decisions yourself, it also helps you interpret what the market is doing, because market moves are often driven by collective crowd psychology.
And these behaviors, these tendencies, they're behind most of the common mistakes traders make, aren't they? The stuff Adam Koo talks about.
Exactly. He gives some really concrete examples. First, there's impatience. This is huge. It's that urge to always be doing something, to be in a trade.
The need for action.
Yeah. So traders take low-quality setups just because they're bored or they want the excitement. They get trigger happy. Koo says something profound. Good trading should actually be kind of boring.
Boring. That's counterintuitive.
It is, but think about it. If trading feels thrilling or exciting, chances are you're gambling, acting on emotion, not following a disciplined plan. The discipline should feel steady, maybe even a bit repetitive, not like a roller coaster. Then there's the big one, fear of losing money. It sounds logical to fear loss, but paradoxically, it often causes bigger losses.
How does that work?
Well, fear makes traders snatch profits too quickly. They get a small gain, panic it will disappear, and close the trade. So they end up with tiny wins. But that same fear makes them hold on to losers way too long. They hope it'll turn around. They can't bear to lock in the loss. So small, manageable losses turn into huge ones. Or worse,
They average down.
they average down, throwing good money after bad, digging the hole deeper, all driven by that fear of admitting they were wrong and taking the loss.
Ouch. I can see how that spirals.
And third, tied into all this, is inconsistent risk per trade. This is directly linked to emotion. You have a few wins, you feel great, overconfident.
So you risk more on the next trade.
Exactly. Then you take a loss, maybe a big one because you over-risked. Now you feel fearful, hesitant. So on the next setup, you risk way too little, or maybe you freeze and don't trade at all. Your risk becomes totally erratic, driven by recent results.
Ku had that example, right? 5 wins at 1% risk, then 4 losses at 5% risk.
Yeah, it's a perfect illustration. You win 5 trades, risking 1% each. Great, you're up 5%. Then you get cocky, risk 5% on the next 4 trades, and lose them all. That's a 20% loss.
So you won more trades, 5 versus 4.
But you ended up with a net loss of 15%,
Yeah.
all because your risk wasn't consistent. Emotion completely destroyed the underlying edge your system might have had.
Wow. That really hits home how critical the mental side is, which leads us to pillar 4, maybe the toughest one, emotional transcendence. This is about the discipline, the emotional control to actually apply your edge.
Yeah.
Consistently, through the wins, through the losses, sticking to the plan. How do you even achieve that? Especially when you're in a drawdown or the market's going crazy, it sounds incredibly hard.
It is hard. It's arguably the pinnacle of trading skill. And it often requires actively, consciously working on yourself, basically, rewiring your brain's default reaction.
Wiring your brain, how?
Well, Adam Grimes talks about tools like meditation and even hypnosis. He calls them powerful tools for literally rewiring themselves. He found they could help increase focus, improve learning, even reduce the need for sleep.
Meditation for trading.
Yeah, think about it. If you consistently panic and freeze when your stop loss gets hit, you could use visualization, maybe guided meditation or self-hypnosis, to repeatedly practice seeing the stop get hit and then calmly executing the exit as planned. You're building a new neural pathway, a new default response. It's about achieving clarity and control over instinctual reactions. Adam Koo focuses on slightly more conventional but equally vital tools: meticulous journaling and regular review sessions.
Keeping a trade diary.
But not just K&L, it's about why you took the trade, what your emotional state was, where you deviated from your plan if you deviated. It's about tracking your own behavior.
So you can spot your own bad habits.
Exactly. And then reviewing that journal systematically, looking for patterns over a large number of trades. Koo suggests 100, maybe even 300 trades, allows you to see objectively where your psychological leaks are. It validates your system, sure, but more importantly, it helps you identify and fix your own behavioral flaws.
So it really is about building new habits, new behavioral connections inside yourself, calibrating your internal responses for the market environment.
That's a great way to put it. Internal calibration.
And this focus on large sample sizes, consistent behavior. It loops back perfectly to Koo's analogy about professionals copying the casino's business model, which sounds weird at first, right? Casinos are where people lose money.
It does sound counterintuitive, but it's actually spot on. See, amateur traders tend to think short term. They judge their system and themselves based on the last few trades.
Right, a couple of losses, and they think the system is broken.
Exactly. So they ditch a potentially good system prematurely, or they go chasing the next shiny object, the Holy Grail system that supposedly never loses, which we know doesn't exist. They crave certainty in a game of probabilities.
But the pro, like the casino,
The pro understands that profitability doesn't come from the next trade, or even the next 10 trades. It comes from executing their edge consistently over a large sample, hundreds of trades. Over that large sample, the statistics, their small edge, will inevitably play out. Short-term luck, winning streaks, losing streaks, they all get smoothed out by the law of large numbers.
it's about playing the long game with the odds.
Precisely. And Adam Grimes echoes this. He stresses that consistency is vital for your behavior, executing the plan flawlessly every time, even though you know your results will absolutely not be consistent day to day or week to week.
Your equity curve won't be a smooth line upwards.
Never. It will have bumps, dips, drawdowns. That's normal. But the consistent application of your edge is what ensures the long-term upward trend. It's about trusting the process, the statistics, not getting thrown off by immediate outcomes.
Okay, so let's try and wrap this up. What we've really explored today is that genuine trading success. It's not about some magic formula or winning constantly. It's about finding a real statistical edge, however small.
Having humility about it.
Accepting it's a long journey of personal development, maybe 3 to 5 years or more. And fundamentally, it's about mastering those 4 pillars, especially the psychological ones, understanding your behavior, achieving emotional control.
Absolutely. The mental game is paramount.
So if we know most traders fail because their expectations are wrong and because they react emotionally, then becoming successful really means embarking on this deep journey of self-awareness, of behavioral change, maybe even more so than just analyzing charts.
I think that's exactly right. It's as much, if not more, about mastering yourself as it is about mastering the market.
Which leaves us with the final thought for you to consider. What part of your own approach, your own reactions, might need a bit of that internal calibration, that rewiring? And how could working on that not just improve your trading, but maybe bring more discipline and clarity elsewhere in your life too? Something to think about.